Thank you very much, and good morning, ladies and gentlemen, and a very warm welcome to the BCO's mini-conference 2021, Reimagining Our Workspaces. It's a great pleasure to be here in person after so long, and the BCO's huge thanks to Delancey for very kindly hosting us here at Plexel, and to all of our sponsors whose names will be appearing on the screens. Just one, but very important house notice, if I may. There are no fire drills planned for today, so should the alarm go off, please make the reasonable assumption that it's serious and make your way swiftly but calmly to the nearest available exit. Now, over the last 18 months, the word unprecedented has become something of a cliche. Politicians, scientists, economists, and pretty much everyone else, including me, to be fair, have used it freely. But the shock and scale of the coronavirus pandemic really has been extraordinary. In the post-war era, unprecedented is not an exaggeration. Like so many others, the BCO was hit hard and fast. I recall all too vividly the PM's instruction on 16th of March last year that we should all work from home if we could do so, and I closed our office the next day. The great and soon-to-be global work-from-home experiment began, and soon after, a few self-appointed experts popped up proclaiming that the office would be no more, and a little more on that in a minute. Now, how quickly we all adapted to technologies such as Zoom and Teams, of which most of us knew little or nothing just the week before. The UK's broadband infrastructure proved to be exceptionally robust, and we all went through a process of instant workplace reinvention. In BCO terms, my overriding priority was to continue to deliver as good a service as possible to our members in the likely prolonged absence of the physical events programme they so much enjoyed. I'm enormously grateful to my team and the many, many members who've worked so hard over the last year and a half to make that possible. The challenge really was huge. It's easy to forget, but those were the pre-vaccine days, and none of us knew how or when we might get back to the physical world. Important events, such as the annual conference scheduled for Toronto in 2020, were first postponed to 2021 and then sadly cancelled. The regional and national awards competition had to be completely reordered and ultimately turned into virtual ceremonies. A regional and national webinar program was established from scratch. 2 interview series were created to try and provide informed commentary for the membership as we worked our way through the pandemic. The BCO's expert committees worked extraordinarily hard to produce a series of briefing papers on a range of vital subjects, from ventilation, lifts and washrooms to the design and fit out of space as we return to the office. It has been a massive collective effort, and my sincere thanks again to all of those who worked so hard to make it possible. I mentioned earlier those who had predicted last March that the pandemic would lead to the demise of the office. Well, I would say this, wouldn't I? But I think not. Yes, there will undoubtedly be a profound impact and probably some longer-term consequences yet to be considered. But as has been said frequently by the BCO over the last year and a half, we are all social beings and we like to get together. Any sensible business will want to make effective use of the technologies with which we are all now so familiar, and I, for one, certainly think that the hybrid model of working is here to stay, but we still need an office, although almost certainly a better one. Effective recruitment, team building, motivation, and so much more which comes from being together physically simply cannot be replicated in a virtual world. To quote Rory Sutherland, advertising guru and one of my guests on the Office Briefing interview series, perhaps the perfect office of the future will be a combination of a library and a pub. It certainly sounds good to me. The most reassuring aspect of the last 18 months has been the exceptional loyalty and commitment of the BCO's membership. While pretty much every business has been hit by the pandemic, our membership numbers are almost identical to the pre-pandemic world. We've tried to offer the best possible virtual service, but there is no doubt how much we have all missed the physical events program, well illustrated by the full house here today. The BCO's expert committees rose instantly to the challenge to deliver today's program, and my sincere thanks to them and to my own team for working so hard to make today possible. Now, before I hand over to Robin, who will introduce our keynote speaker and chair the rest of the morning, an introduction to yet another technology, Slido. Now, this is a, quote, interactive engagement platform, as the boffins like to call it, to allow for simultaneous questions and voting by our physical audience and our virtual audience watching today remotely. So, to show you how it all works, could I ask you please to get your phones out, if you haven't got them out already, and open a browser, Safari or whatever, and find the website www.slido, that's SLIDO.com, www.slido.com, and enter the event code BCO. Excellent. Now, if you've all done that, you should find the icebreaker question, which is, have you used Slido before? Everyone got that? Fabulous. So just please answer it, if you wouldn't mind. I think I know what the answer will be. Oh, some have. That surprises me. I'd never heard of it, but you're ahead of me. Not for the first time. Well, it works. And we have some floating voters, I think, in the audience, but it seems to be working. Fantastic. Well, that proves the technology works. That's pretty much all from me. Have a great morning, everyone, and I'll be back after the lunch break. And please now give a very warm welcome to the President of the BCO, Robin Brody-Cooper.
Thank you, Richard, for that warm welcome. Ladies and gentlemen, I'd like to introduce you to our keynote speaker. I have known Savvas for a number of years. He has been involved in commercial finance since 1991, working at a series of investment banks, and he has been a partner and chief economist at the Toscafund from 2008. He has taught extensively in London at the LSE and the University of Woolwich, as well as Oxford and Moscow universities, covering statistics, mathematics, and economics. He has authored various academic papers published in peer-reviewed journals. Savvas holds doctorates, master's, and bachelor degrees in econometrics, mathematical economics from the London School of Economics. I'm sure he will dazzle you with his amazing insights on the world and where the markets are heading. Please welcome Savvas to the stage.
Thank you very much. That was a very kind intro. There's something I need to add as well. I'm a partner at Toscafund, and this is not mere conversation. Toscafund, as you may know, launched the regional REIT, which is now a London-listed office provider with offices extensively around the UK, beyond London. It's got about £1 billion of assets. You may also know that We are a significant investor in IWG, formerly Regis, so office matters to me both personally and professionally. If I get economics wrong, I become poorer. And in terms of this episode we're in, I want to deal with today, next year, and when it began. But for context, let's talk about the immediacy of what we're seeing in terms of disruptions to supply chains. They will have a very short half-life. Do not imagine that these are going to become embedded. There's a concept in economics known as hysteresis, which is effectively when a problem compounds itself and becomes embedded. The mismatches and the frictions that beset this economy through my youth, through my education, and the early part of my career have gradually and favourably been removed. We know that when the pandemic began, quite rationally, a great many Europeans with the right to reside in the UK and settle in the UK took their furlough money and returned home. And as we know, the furlough scheme ended a few days ago. Do not be surprised in a year's time when we realise that something in the region of 750,000 Europeans will arrive in the space of 12 months. Why? Because they have jobs here that will reopen, and quite frankly, for context, the narrative for the UK will be exclusively for the UK. Don't imagine that it extrapolates to what's going to happen in Europe or what's going to happen elsewhere. Every territory of the world has a different DNA. And don't let sort of journalistic nonsense tell you that somehow there's a broad inflation problem around the world. Inflation will become a problem in certain places, deflation elsewhere. Insofar as the UK is concerned, inflation is rising. It won't become embedded. Inflation is a good thing. Inflation around, central banks target inflation to be between 1% and 3% because they don't want zero, because zero is too close to negative territory. And once you get deflation, things get very, very shit. And that's the story for the Eurozone. In terms of the UK, we were very, very lucky that this crisis struck in March of 2020. Had it struck in any previous March, all the way back to really the early 2000s, many of the ingredients that we see the UK exhibiting or recognising in the UK were absent. So when this crisis struck, our banks were incredibly macro-prudentially fit. Balance sheets were healthy, the property markets were healthy in a way they hadn't been in earlier years, particularly after the banking crisis of 2008, which was a genuine problem. And by the way, those of you who are at the dinner tonight, you may want to sort of keep your bread rolls back for the after-dinner speaker, because Justin Webb, who's probably one of the nicest men at the BBC, his institution has helped contribute significantly to these shortages, because if you broadcast something, it becomes self-fulfilling in many ways. And it reminds me of 2007 to 2008, when a former colleague of his, Robert Peston, began to use his social media profile and his sort of BBC account to tell us there was a problem with Northern Rock, Bradford and Bingley, Alliance of Leicester, Bank of Scotland, Halifax, RBS. And there were problems with those banks because they'd been regulated badly, but those problems were amplified because the BBC began to talk about them. And you created bank runs that saw what should have been an orderly decline in Northern Rock and Bradford and Bingley and Alliance and Leicester become a disorderly rout. Okay? So you can thank Mr. Webb's organisation for exaggerating the 2008 crisis and for making this one worse. The good news is that the fundamentals of the UK economy are very sound, because, to repeat, our banks, which had been so badly regulated up until 2007-8, were passed into the hands of the Bank of England, and the Bank of England has done a remarkably good job at making sure the banks are not reckless anymore. So we have good retail banks in a way we didn't have in the period up to 2008. The property market is sound thanks to the fact that we've got good demand and supply fundamentals in both commercial and residential. We have a government that a mere 3 months earlier did not exist. Just imagine if this crisis had struck in the early part of December 2019. Boris Johnson was PM only in name. Had the crisis struck any date before the 12th of December, I don't do politics, simply do economics. Had the crisis struck, just imagine, had the crisis struck when you had a Tory party divided in Westminster, the SNP sniffing down their throats, Jeremy Corbyn was still, in effect, the leader in waiting as the head of the Labour Party. What you would have had would have been that horrible animal, that mythical animal, the GNU, a government of national unity, and it would have been anything but unified. We were still in the European Union, so the latitude to navigate out of this crisis wouldn't have been unilateral. And by the way, had this crisis struck a mere month earlier, we wouldn't have had Rishi Sunak as Chancellor, who has not put a foot wrong. I'm incredibly critical of Chancellors. I've seen the rubbish that was George Osborne and Hammond and Gordon Brown, and you could go back. We have the real deal. He knows what he's doing. He knows his onions. And the longer he's Chancellor, the better for all of us. So the UK came into this crisis in incredibly good shape. And had it struck any time before when it did, I couldn't have said that. Now, in many ways, this crisis has medically been a problem to those with pre-existing conditions. And the same thing applies to economies. If you came into this crisis with a pre-existing complaint, your ability to emerge from it is fraught. We're talking about Japan, much of club-med Eurozone land. So think about Portugal, Spain, Italy, France, Croatia, Greece, Cyprus, Malta, Bulgaria. Large tracts of the European Union, and this is not some sort of diatribe against the European Union. The simple truth is that tourism levels will never return to 19 levels across club, med, Eurozone land, because you're going to see two things happening. The likes of Turkey and Egypt and North Africa generally, so close short-haul destination rivals to the southern European nations, will devalue. Those of you who are thinking of booking a holiday, you'll notice in next year Turkey will become materially cheaper and more affordable because their currency is poised to go off a cliff edge. Egypt will follow. So this will compound problems across the Eurozone where tourism matters. And we can include both Alpine and Mediterranean coastal nations. Now, think about the UK. The UK is has a net deficit in tourism. We have a net deficit in trade. We have a significant surplus in services. So this crisis really has impacted us favourably because it's kept travel money at home. It's promoting now reshoring of production. We will never again have inventories that are just in time. We will have inventories that are just in case. Now, that creates jobs, it creates demand for warehousing space, logistics, which brings me to another point that the UK is unique in. And it might be an opportunity here to just to give some flavour to this. You need to understand in context where the UK is in terms of its economy. So we came into this crisis. So back in 2008, barely 4% of retailing was done online. Progressively, unrelentingly, that was pushed to around 20%. Remarkably, in the closing months of 2019 and the early months of 2020, it appeared, remarkably, that the retail internet penetration was peaking at 20%. And then we have lockdown and we surge. Compare the UK with other countries. Having the logistic network and the warehousing that the UK had, which is unique in the world. No country on the planet comes close to the UK in terms of its the egress of e-commerce into our lives. But why this matters is that when you lock down an economy, you frustrate the movement of money. And the velocity of money is what creates an economy. In the case of the UK, we continued to consume in a way that other countries didn't benefit from. And by the way, recessions have very unique qualities. A recession happens when industry or industries decline suddenly with no compensating growth elsewhere, when the jobs lost have skills and talents that don't match to any jobs being created. And a recession happens when you have a localized problem. Now, whether it's a shipyard or a steel mill or a coal mine, or the whole of Yorkshire and Edinburgh and London being hit by a banking crisis, no one part of the UK was particularly badly hit by this crisis. Just as we know that industries collapsed, we also know that in terms of employment, the UK has had a remarkable rebound in. I'm not going to grandstand here, but when this crisis began, we had record high employment, record low unemployment, and we also had record vacancies. Again, timing is everything. So we couldn't be more lucky or fortunate in the way this crisis struck when it did. And there was no doubt in my mind, my PhD is in labour economics, and I know a thing or two about the labour market. There was no doubt in my mind that there'd be a rapid recovery in vacancies. And in terms of where they've come through, you can see this is a map of the UK. Don't be blue. This is all comparative. Blue and red reflect comparative hot spots and cold spots. The numbers in each region reference off 2019 at 100. So even the blue parts are stronger than they were in 2019. Why do we see particularly strong signs in the Midlands and the North East? In many ways, logistics, warehousing, these are hot spots. We also know that, to repeat, London's been particularly badly hit. Again, it's got a score of 104.8, so it's 4.8% stronger in vacancy terms than it was in 2019. But that is nothing compared to the 60.3% in the North East or the 47% up in the North West. Now, in terms of where these people are where these jobs will be filled from, we know that from 2002, something in the region of 7 million Europeans were given national insurance numbers. Do not trust migration data. While we were in the single labour market of the European Union, someone from the European could come to work here and not be counted as a migrant. So the only data you can use is data on national insurance numbers. And you can see the issuance of NI numbers. So remarkably, 12 million were issued, a short 12 million cumulatively from 2002. But the important point is that when the crisis began, maybe, no one's quite sure, but possibly upwards of 1 million Europeans went home with no intention of staying there once the klaxon sounded the all clear for the UK. And they will come back, and we know they'll come back because look at this concentrated period here. These are official Home Office statistics showing the number of Europeans who applied for and were granted settlement status. So we can't say all of those Europeans with NI numbers were granted settlement status, but we do know something in the region of 85% have been. And we know that the Home Office have been issuing these even though the deadline passed in July, there's been some dispensation to keep issuing them. So do not be taken in by journalistic nonsense that we have a labour crisis that's going to be ongoing. Yes, you can't deny it's happening. Yes, you have to accept that broadcast media have made it worse. But do not imagine that this time next year, this will be the narrative. Other things would have followed through. And by the way, in terms of what this does for wage inflation, this country will enjoy positive real wage growth. Because the simple truth, again, is that we are in a sort of situation where we're exaggerating inflation. Inflation in the UK will spike to 4%, but it will come down because there are so many disintermediating, disruptive technologies. So disruptors are being disrupted in e-commerce and e-finance. We are a big investor in a private capacity and a public capacity in disruptive technologies. And what they do effectively is they keep pricing contained. Because you disrupt an industry or sector in e-commerce, on e-finance, you're bringing down pricing points. You're not creating inflation, you're creating the seeds of deflation. And the good news is the UK will have inflation going forward in the region of 2.5%, which is nicely around where the Bank of England is monitoring. In terms of the base rate, it was always going to be the case that the UK would raise base rates before the consensus was suggesting. Do not be alarmed. Do not let the BBC tell you that a base rate rise is in response to bad things. The base rate being close to 0.1, is a bit like being on a life support machine. It's reassuring when you're taken off. And this really leads me to some context. I've touched upon Europe. Those of you looking at currencies, I mean, the pound is like an open window for a burglar. Okay? It is woefully undervalued. Okay? Those of you who, if you ever meet an FX trader, play a little game, put them alongside a wall and shine a light through their ear, and you'll see is the light going straight through. Okay? So, but the good news is, so what the FX dealers do badly is capitalised on by Australian, Canadian pension funds, capitalised upon by Apollo and KKR and every other American or global private equity business, because UK PLC is for nothing. It's 20% undervalued through currency alone. And by the way, if you think these black lines are ambitious or fanciful, the gapping up in sterling, just to reflect back. So in my career, I lived through the pound's exit from the ERM. The pound went from close to 3 Deutschmarks to close to 2, and it stayed there through 92, 93, 94, 95, 96, 5 years, and then this happened. By 1998, the pound was above where it had been 6 years earlier. And when it began to move, it was dramatic. And I'm a great believer in sort of Einstein's wisdom about insanity and knowledge. If it happened then, it will happen again. And one of the triggers, one of the catalysts for the pound going up, closing that open window for the UK being very, very, very cheap, will be when the Bank of England raises the interest rates, which it will do. Don't reflect on that being a negative thing. Oh, by the way, any questions at any point, please ask. So to give you some context, this is an example of the blue line on the left is employment in go-to consumer sectors, and the red line is destination retailers. And no great surprise that from 2012, as we began to engage ever more in e-commerce, what had been effectively an even number of jobs in both go-to and come-to, look at the surge in the blue line. And going forward, that's going to get stronger and stronger, because the simple truth is, when you buy things from the cloud, the goods don't simply drop out of the sky. For the same quantity of consumption, more workers are needed online than destination. Again, there's a myth, or it's a mythology that somehow if you use AI, it's job destroying. It isn't. Literally, all of us, when we order from Amazon or from other delivery mechanism, we are getting personalised shopping. The last time we had personalised shopping, it was very bland. It was basically the doorstep milk delivery. And when we had doorstep milk deliveries, there were 4 companies in the FTSE 250 that did nothing other than that, okay? Because it's very labour intensive and very accretive. So we've gone and supercharged delivery from the doorstep of delivery of milk in no time slots, something which is bespoke, which is incredibly labour intensive. Are there jobs that you want to do? No. But the important point is the jobs being lost require the same talents as the jobs being created. Compare that with the proper recessions. When a coal mine or a shipyard or a steel mill closed down, you had skilled manual men in very specific parts of the country who were never again going to get anything like the earnings they were getting in their manual skilled trades. That's a proper recession. This is not, I'm not trying to be inconsiderate or insensitive to those families that have had a problem through this for 18 months economically. But the simple truth is that economically in the UK, we have had something in the region of £750 billion of enforced savings upon us. This is a £2.5 trillion a year economy. So you're talking about something in the region of, well, do arithmetic, £750 billion on a £2.5 trillion economy. Huge amount of dry monetary tinder about to be released. It won't all go into GDP. It will go into investments, into property, into baubles, into fine cars and good wines. The important point is, this is not a recession. Anyone who conflates this episode with 2008 doesn't understand economics. 2008 was a real shit show, made worse by the BBC. The 9/11 threatened to be a really big problem. I can go back to the 70s and 80s when you had real restructuring problems in the UK. This country almost didn't emerge into the 1990s because of the traumas of the 1980s. We got through those, in large part because we just got through it. Now, across Europe, you weren't getting the restructuring, you weren't getting the supply side reforms the UK had. So this is really, again, all I do is data and numbers. You've got 3 lines on each graph. On the left, you've got conventional interest rates, the Eurozone, UK, and the US. On the right, you've got what is known as sort of quantitative easing, unconventional monetary policy, which is basically literally pumping money into the economies. Now, what you notice is, look at the 2008 crisis. We, in the Bank of England, immediately responded to what was an existential crisis. I won't say unprecedented, it was existential. It never happened really since the 30s. We cut rates, the Americans cut rates. Look at the Europeans, that red line. They could see a crisis brewing across the Eurozone, and they were raising interest rates. Then they began to cut rates. In 2011, as Greece and Portugal and Spain and Ireland were struggling with banking crisis, again, the ECB raised interest rates. I remember watching it thinking, what are they doing? And then finally they capitulated in 2015. And the problem is, when they capitulated, it was too late. Quantitative easing, the red line, they only began to print money in 2015, 7 years after the crisis began to show itself. Look at the way we responded in the UK and the Americans responded. So this is allowing for per capita dollarized QE, so to normalize it. And you see that what's happened is that we were nicely in the middle, and we've been nicely in the middle since. The Europeans haven't responded because they're collectivized. They have no maneuverability on interest rates because they didn't cut them in time. We had the ability to cut rates because we'd spent a few years. I mean, this rate cut here was sort of Mark Carney sort of performing sort of a hero syndrome rate cut. The UK didn't need a rate cut after the Brexit referendum when the shot way. And that's why that rate cut was then turned around. Go back to 2016. By leaving the European, but that shock referendum result saw a shock fall in the pound, which meant that the UK had a competitive disadvantage that held us in good stead when this crisis began. And this is not, to repeat, do not allow others to tell you this is a recessionary problem. This is existential, yes, but it has none of the hallmarks of recession. And you don't need to look at the vacancy numbers. And to repeat, the jobs that have been lost require the same talents and skills as the jobs being created. On top of which, this country has seen a huge increase in bioscience. Universities have had a very good crisis. If you're an academic or in the public sector, it's been a rather comfortable 18 months. Again, this may sound insensitive to those who've been impacted medically by this crisis, but monetarily in aggregate, this country has had a very good crisis. Insofar as the borrowing, gilt yields have not moved. Do you know why? Because there's a global appetite to own sterling assets. Because the global economy really has been over-invested dollars. So what you have in the Eurozone is the real and present danger that they go into deflation, made worse by the fact that there's no response coming from the ECB. Over in America, where you've got Biden pumping dollars in, the Federal Reserve pumping dollars in, you've got a real inflation problem, on top of which you've got a currency problem. So the pound will go up against the dollar in large part because we all raise interest rates, but also in no small part because the Americans will find that the appetite for their currency is going down because exchange rates are relative prices. Some more detail. This gives you an illustration. This is Bank of England data. These bars are the surge in saving in aggregate. The chief economist of the Bank of England, Andy Haldane, went public in October last year. Very bravely, he said, At that point, he estimated that the enforced saving was about £250 billion. It was perceived to be insensitive to talk about money when the country was embroiled in a medical crisis. He was simply stating facts that he was picking up from very, very reliable data sources. Other factors, let me just run through a few other points because I want to take questions if I can. This is a table that really, those of you who are enthusiasts for the for the Eurozone, look at the first two columns. Tourism will never repair itself across the Eurozone. Be prepared for ongoing disruptions as governments looking to fix their fiscal positions impose aviation fuel duties that don't exist at the moment. There'll be taxes on travel. Then you've got flight shaming. All those things basically mean that if you're an economy where a quarter of your employment is tourist linked, you need some other model, and there isn't another model you can employ. The countries that have red numbers are those that benefit when we can't travel, and we're in red. I would dismiss Ireland, Irish data is just completely fanciful, but you get an idea that there are very few countries that score red here, i.e. that benefit when tourism is interrupted, and a great many countries are up there that have some very serious problems ahead. The property market across the Eurozone hasn't been exposed, and therefore the banking crisis across the Eurozone hasn't been exposed because there's been no mark to market. Would you go and buy a hotel or a bar or a restaurant along Club Med? Of course you wouldn't. And yet banks across the whole of the Eurozone have loans out to the very real estate that has at some point to face a mark-to-market revelation. Loan to values will basically go to the moon, covenant breaches will become a crisis point, and we can all reflect back to 2009, 10, 11, when it last happened across the Eurozone. And we can all reflect back to the paucity of response from the ECB. And to repeat, this time around, there's nothing in the tank for the ECB. Over in Asia, do not doubt China, and I'll just move across to dealing with that titan of a country. I could give you chapter and verse about events in the UK and the Eurozone, but I'll summarise it in this way. The Eurozone has a deflation problem. You won't want to touch their real estate. The UK has nothing of the sort. Okay? In a year's time, we'll look back and think how the absence of mismatches and frictions saw us come out of this. The return of Europeans as much being pushed from weak economies as being pulled by the UK. But just give you an idea about where we sit. China, just to give you an idea, the black line on the left is how much China has in the tank. Over $3 trillion of undeployed savings. This year, it will earn another $500 billion through its current account surplus. This is the only country on the planet which has money in the bank. It has interest rates close to 4%. There isn't a problem that China can't deal with, okay, fiscally or monetarily, okay? And the important thing about China is if you want to understand where we sit, this is the UK. So this is how much China has spent around the world since 2005, cumulatively. The UK is not per capita. If you look at the UK's position, only Australia and Canada really, in per capita terms, come close to matching us. If you look at Switzerland being on that list, Switzerland is there because the Chinese bought a company called Syngenta, which effectively is a British company. So you can take the Swiss money and lob it onto the UK. This is through official sources of data. If you actually look at unofficial sources, that is what China has stuck into the UK, and this is where it stuck it to. There's been no single industry that has been biased. Okay, those of you who are worried about sort of China's influence on the UK, okay, through Huawei and stuff like that, just think about on a Monday, academics at Imperial or King's College will complain about Huawei. On a Tuesday, they'll cash Huawei checks. Okay, and that's the simple truth. Other countries are benefiting in a way. The UK is heads and shoulders ahead of Europe in terms of it being a destination for Chinese investment and Chinese students, all very accretive. I would not be surprised if in the next 15 years, the run rate of Chinese students coming to the UK annually will be about 250,000. And the reason it'll be 250,000 is because of this. This is a demographic. So economics is all very good, but sometimes you need demographics. What you have on the left, the black line, is the babies born in China in 2016. And there are about 18 million births. No one's quite sure, 17.5, 18 million. Of those 18 million, about 1 million were born into affluence. By the time they turn 18 in 2034, over 3.5 million will, conservatively speaking, will be blowing candles out on their 18th birthday cake in affluent families. The world has never seen this before. By comparison, you have India here, which, if you were to basically, if you were to treat them with different axes, India looks to be growing more affluent. So the blue line is the 2002 babies and their evolution, and the black line is the 2016 cohort. If you put them on the same scale, and by the way, India and China produce, broadly speaking, same number of babies a year, same scale, India shows no growth by comparison with China. China's going nowhere. China has no military ambitions. Don't let sort of journalistic nonsense. China can buy the world monetarily. It doesn't need to invade countries. The single piece, the missing piece of the Chinese jigsaw was handed to it a month ago by the Americans. It always wanted Afghanistan, so it could create an even closer land route to Turkey. It now has Afghanistan, Iran, Turkey, Europe. It's developing Pakistan. China is a force for good, not for evil, because it's not benevolent. It's not buying up the world because it has some sort of benevolence attached to it. It's self-interest, but it's favourable self-interest. So the context is we may be nestling alongside Europe, but in terms of our engagement internationally, it's going to be with Asia. And we will also be paired up with the Australians and Canadians, who are doing remarkably well from China, even though there's a degree of pushback. And as they do well, not only do we get money directly from China, we get surpluses in Australia and Canada from their Chinese money coming here to buy our real estate. This is not, I don't eulogize, okay? You've been fed a sort of dystopic view of the UK, which has no similarity with the fundamentals of the UK economy. And to repeat, in large part, this narrative only is possible because of the timing of this crisis. And it's almost chilling to think that had it struck 4 months earlier, in the early part of December, we'd be royally fucked. Anyway, so any questions?
One question from me. Do you see a time when the RMB will be taking over from the US dollar as the world currency?
So, as if by magic, is that there should be a slide here somewhere that illustrates, again, the fact that this is a, that don't be put off by, this is simply just numbers, that once you sort of look at them in context, you'll realise. So the first column is how the Chinese manage their currency. Until January of 2016, it was exclusively managed against the dollar, hence the 100%. Then progressively, unrelentingly, more and more countries have been added to its basket. And you'll notice the pound's there as well. This column here tells you when the Chinese signed a currency swap arrangement with a third party. And what does a currency swap do? It effectively disintermediates the dollar. It says, why are we buying and selling from each other in dollars when we've got our own currency? You've got the Brazilian real, you've got the Turkish lira, you've got the pound, you've got the Aussie dollar. Let's just cut out the dollar. Every time this column moves, the dollar goes down, it's another nail in its coffin. Now, a weak dollar is disinflationary. Okay, remember that inflation problem that I said would go away? Another part of it will be because a weak dollar is disinflationary. So the UK is here. So the reason we're getting Chinese money is because we're in this list. And our share will go from, it's currently 2.75, it's been higher. That's going to go to 4 or 5% because that's the share that the pound accounts for what is known as the special drawing rights. And one final point about the RMB. The Chinese have not put a foot wrong since 2002. China doesn't turn 20 as a macroeconomy until December, because it was only in December of 2001 that it was allowed into the World Trade Organization. So it turns 20 in December. And in March, it hosts the Winter Olympics. And it's promised that all the attendees of the Winter Olympics will be using a digitalized currency. Not a cryptocurrency, but a digitalized form of the RMB. And the Bank of England is also discussing in advanced discussions about having a digitalized currency. Don't be worried by it. It's not an infringement of your liberties. A digitalized currency is something to be feared if you are part of the black or grey economy. And what China is doing is saying, we want to basically let nobody operate outside the realms of paying tax, which means we can cut average taxes, because at the moment, the taxpayers are bearing the burden of paying tax that others aren't paying. So those of you who've got a cryptocurrency investments, every time someone talks about digitalizing their currency is the death knell of cryptocurrencies. You simply can't have cryptocurrencies alongside digitalized fiat currencies. So the answer is, it's a long-winded answer to a simple question. China isn't going to go away. It's not going to blow up. It's barely, to repeat, it's a teenager still. It stops being a teenager in December. It's in terms of where it is in comparison, America as a macroeconomy really only began to appear in the arguably 50s. So America is in its sort of 70s, 80s. It's going to disappear. You could take the European Union, the US, add the populations. You don't touch the size of China. There's never been, since man came blinking out of caves, there's never been a macroeconomy like China. Every textbook I read in the 80s as a student is equivalent to reading pre-Newtonian physics textbooks. Irrelevant.
Right, my Slido is lit up. We've got a few questions. All right, politics aside, in your opinion, as a PhD holding economist, was Donald Trump the economic and business genius he claimed to be?
No. That's funny, that is. That's funny. No, he was in his own little universe. No, the die was cast. Trump, look, America's problems are so deep-rooted that I just don't know where to start. I don't want to malign them. America's problems really, in large part, have been a consequence of the dollar's monopoly on global savings has been both to the benefit and the bane of the US economy. It made them addicted to debt and to cheap money. And that can't continue. Imagine when the Federal Reserve begins to raise interest rates. The American economy isn't equipped to shoulder those high borrowing costs. So you've got three things in America. You've got housing sector, federal government, state government, and corporate sector. Oh, and the fourth is banking. Okay, the only healthy element of the US economy that's got bulging balance sheet is the corporate sector. State and federal government, insolvent. Households will be insolvent if there's a rate rise. Banks rely upon a healthy housing market. So the only way you can square that circle is by taxing the corporates aggressively to extract some of their surplus savings. So there's a lot to go wrong in America going forward.
Right, I've got two quick questions because we're going to move along. I've been given the signals. Obviously, this comes from a homeowner. It says, will there be a crisis for homeowners who have overborrowed when the base rates rise?
Good question. Look, the resi market in the UK entered this crisis in the healthiest possible state because, to repeat, you didn't have the reckless self-certification of Bradford and Bingley, Alliance of Leicester, Northern Rock. In fact, going forward, do not mythology again. So when we entered this crisis, we had more equity in our housing than in the history of the UK. Okay? There was no negative equity problem, even remotely happening. But going forward, disruptive platforms will ensure that as the base rate goes up, mortgage rates go down. Think of Starling Bank and Monza and Atom Bank. They're coming in aggressively. They're buying platforms to become mortgage lenders. And they want market share. And where they get market share is by being very competitive. So far from there being a base rate response to mortgage rates, that will be disrupted by the fact disruptors are coming along. The Americans are giving us fortunes in the buy-to-let market. They're funding Starling's ability to go and buy mortgage platforms. Atom, we as a firm that I'm familiar with, that was being bid for. Atom wanted it, Monzo wanted it, Starling wanted it, Starling got it. Okay, so there's no housing crisis because, bear in mind, you need a supply problem or a demand problem, and neither of those loom remotely in the UK.
Right, one from Simon Russett. What impact will the likely failure of Evergrande and other Chinese development companies with debts of circa $500 billion have on the global markets?
None. Because you've got $3.5 trillion and counting of state money. You can nationalise it the way we nationalised Northern Rock, RBS, and it won't touch the sides. So again, thank you BBC for taking a problem and exaggerating it, because you've got no idea what the fuck we're talking about.
Right, I better make this the last question. Do you believe climate change will have any bearing on these traditional economic statements?
Look, the climate change, so the yin and yang of the economy and the environment, and I'm not being glib, the worst thing for the environment is a recession, because a recession basically, it favours unclean companies. So if you're a climate activist, the thing that you want to avoid isn't a healthy economy, but a recession. And if you induce a recession, okay, you're actually counterproductive. But you can't teach them that because they can't hear it through all the hair.
Thank you, Savvas.
You're welcome.
Fantastic. Thank you. Well done.